sectors get hard hit?
Well, obviously tech. You're seeing that right now. We're down about 1.5%, at least 2 for the NASDAQ 100 and the largest technology stocks there. So you saw that spike in 10-year yields, 75 basis point hike, pretty much guaranteed later on this month. 80% probability of another 75 basis point hike in September. So that's 3 jumbo rate hikes in a row. Also, there's a almost 50% chance now of a 100 basis point hike later on this month.
What tells you that? What tells you this expectation?
Fed funds futures, that's what I'm looking at.
That's what you're looking
at. And that's telling me that Wall Street is expecting a near 50% probability of a 100 basis point hike, which would be the highest since going back to the Volcker years in the 1980s.
Right.
Let me ask you this, though, because I'm trying to figure out what that means and what that signals for the stock market if they just rip the Band-Aid off. We all know inflation is at its highest in 40 years. If they go 100 basis points later on this month, I think stocks would actually rally.
I think you're right. Because that would be almost doing a Paul Volcker.
Right, and that's
stamp on it
and that's
now.
your superpower because you have historical context. You've seen this again, and you know history repeats itself. So do we just rip the Band-Aid off, going Paul Volcker, shock and awe, saying we're going to get this under control? And I think that would actually send a positive signal to Wall Street, thinking maybe, look, if we raise interest rates this high in the short term, we could have room to cut into 2023.
Is Jay Powell that tough a guy?
I think he's made it very clear that inflation is his focus right now. And I was reading a Wall Street Journal article yesterday, and again, your superpower is historical context. Do you think we have that ebb and flow in the 1970s where they raised, they cut, and that's when the stock market kind of went flatline during that decade until Volcker came in, and then he went shock and awe, and that's when you saw that bull market run in the 80s.
Without a shock and awe 100 basis point jump in the federal rates. Without that, you may well get a stock market that stumbles along for a few years at a low level, just like the 1970s.
So I heard your Eddie Gabor interview there, and I'll tell you that Wall Street expects that maybe we'll get to 3.5%, probably more now with that 9% inflation print this morning, 3.5% by March of next year for interest rates. And then Nomura says, and I think Wall Street's on board, that if we do get into a recession, I mean, probability is still all over the place. Probably more likely, if you look at the inversion curve right now with the 2s and the 10s at the widest gap since 2010 right now. So that tells me that Wall Street's pretty much pricing in a recession, at least in the next 12 months. But do we have room to cut interest rates in September next year?
A good question. We'll probably answer that next year, I guess.
Well, I think Wall Street is saying if you're going to have to raise interest rates so sharply, so quickly, we're probably going to slow down growth. And how much does growth slow down where then you have that optionality to start cutting to get us out of negative growth?
Do bank stocks go up when rates are rising?
Yeah, and you'll see that later on this week. I think tomorrow is when the bank earnings start. And so they'll usually make more money on loans with higher interest rates. Also, trading volatility, bad for us because we can't stomach those declines. Good for investment banks since they make those commissions. As I mentioned to you, I think the dollar is going to be impacted. That's going to be a running theme throughout the entire earnings season.
It should go up, shouldn't it?
Well, the dollar is at the highest since 2002 because the Fed is hiking rates so quickly in the short term.
So it should go up some more?
Absolutely. And think about what that means, though, for corporate earnings when you bring it back into U.S. dollars. It looks less if you're sitting at 20, 30-year highs against the yen. I think you're at parity for the first time in 20 years versus the euro.
Okay. What about the inversion of the yield curve?
As I mentioned to you, the widest gap we've seen, which is a recession indicator, as you know. So the 2s and the 10s right now, 15 basis points plus. That's the widest gap we've seen since 2010. And as I mentioned to you, I think it's pretty probable in Wall Street's view right now, maybe a 60 to 70% probability we could see 2 quarters of negative growth in a row.